And now for a deeper dive, I'd like to welcome our panelists. Andrew Behar is president of As You Sow, a shareholder advocacy organization. And Magali Delmas is professor of management at UCLA Institute of the Environment and the Anderson School of Management. Welcome to you both.
Thank you.
Now, I want to start off with a question for Andrew. We've talked a lot today about the SEC disclosure requirements. I want to get a sense of what you think of when it comes to whether or not these requirements are laying the groundwork for more information for investors.
The new SEC climate disclosure rules really boil down to one word: trust. It's the SEC's core mission, is to establish trust between a company and its shareholders. And what this does is say, when you disclose material information, which is information that will have a financial impact, it needs to be accurate, verified, and in a standardized format in the audit. So to me, it's like the most basic thing the SEC could be doing, and that we need to have more of that, because a lot of the decisions that are made on whether you want to invest in a company, whether you want to hold, buy, or sell, really comes down to doing your analysis, and it's beyond just the financial metrics. You need to look at some of the other risk metrics that a company is facing, and those risk metrics are what the SEC is saying you need to make accurate. And the problem has been recently that a lot of the, particularly the greenhouse gas emissions data that companies have put out is misleading, and so it gets scraped by MSCI and by Sustainalytics and Refinitiv, and now you've got misleading data mixed in with all this other data, and what we need is good quality data.
Now, do you think the SEC's framework that they've proposed so far, it's obviously still needs to be finalized. There will be a few challenges to that, which we could get to, but do you think the framework they've laid out could get us to that point where investors have that good data?
I think it's, frankly, not, didn't go quite far enough. They gave a safe harbor for companies who are disclosing misleading Scope 3 data. But overall, I think the idea that it needs to be verified by a third party, standardized in format, put in the audit, and that if it's misleading, just like if you had misleading financial information, that it could be challenged by shareholders. So I think we're on the right path. It could be a little stronger, but not a bad go at it.
Certainly. Now, Professor Delmas, I wanted to ask you a question about the database that you and your team at UCLA are working on to track and monitor these ESG disclosures. Tell me a little bit about what you're going to be paying the most attention to.
Well, first, I just wanted to agree. I agree with Andrew in terms of the reason why we're doing this database of ESG disclosure. It's because the current data isn't, as transparent, as we would like. It's often difficult to figure out what's behind these numbers. So we wanted to do this from a very transparent, process, academic process with scientific rigor. So what we're doing is collecting data on the, kind of the biggest companies, the Fortune 300 companies, and seeing what they disclose, how they disclose it. And what we find is that only half of them really kind of disclose comprehensively about, ESG. So that's, kind of, a beginning. But if you think about these companies that are the biggest, the most successful ones, that have the most resources, they're not disclosing as much as we would think. And what we've done is use the World Economic Forum framework, which is kind of based on the supposedly most used metrics. So right now, what the metrics we're really interested in are, of course, the environment and the social, elements. Governance and the other one, prosperity, are already kind of well developed, and I think we have a lot of information on that. But on the environment, we don't really. There are areas where we have almost no information. So greenhouse gas emission, we see a lot of reporting on Scope 1 and Scope 2, almost 80%. Scope 3, we kind of go back to really much lower numbers. 60% reporting. And then water, land use, we have very, very little information. On the social side also, we get less than 20% of the companies we're looking at that are actually reporting, comprehensively information about social elements such as diversity, for example. And so our point is that, this is information that you have to report anyway to, kind of the governments. So it's not that difficult. So a lot of the time we have, companies saying it's going to be hard, we have to do a lot of work. But in fact, a lot of this information already is, gathered by companies.
Certainly. Now, a question for both of you is, this is a lot of information about a lot of different topics that companies are being expected to disclose and, will be mandated to disclose if these rules go through. But what is an investor supposed to do with all that information? What should someone who's, interested in ESG investing look for when it comes to breaking down and making sense of all of this information? Andrew, if you want to start off with that.
Sure. So essentially, you're looking at risk. That ESG just means risk. You're looking at environmental risk. So climate change is obviously one. There's other items. Social risk. It's really about retention of your best and your brightest of your workforce, which is, certainly a big metric that an investor would use to say, is this company going to succeed? Like, can you retain your workforce? How do you promote your workforce? And we actually have asked companies very specifically. We've written letters to 3,000 companies and been filing a great many shareholder resolutions asking companies to disclose their retention, promotion, and recruitment rates, and then cut them by gender, race, and ethnicity. Because the EEO1, the Equal Employment Opportunity Form, which is required if you're going to be doing work for the government or if you're a certain size, it's really the very baseline. And we've now looked at 134 EEO1s. We're actually coming out with a report in a couple of weeks about the EEO1 data, what it shows, but it's very limited. For instance, looking at EEO1 data, you cannot tell if there's a promotion gap for women. You could tell if there's, even if there's a wage gap. What we've seen in some McKinsey reports is that men and women entering the workforce at the same level, at the entry level, by the time you get to a senior vice president, it's about 88% men. So there's a promotion gap. EEO1 will not show you that. It'll show you if there's people of color or women in the workforce, but they may all be at entry level jobs. So the companies know this information, and it's really about, can you disclose this? When will you disclose this to your shareholders so that they can use it to make their buy, sell, or hold decisions?
Certainly. And Professor Delmas, what do you think investors should do with this information and how they should be able to navigate it, when they're trying to make these decisions?
So I think it's just the beginning, scratching the surface of all of these metrics. And there'll be some trade-offs between, some of these elements. I think it's just the beginning for chief financial officers to realize what this does. The research is showing things like, yes, if you take, if you are good actors within your community, within society, if you respond to your stakeholders, you're more likely to retain your employees. You are more likely maybe to kind of reduce your costs in terms of, the efficiency. You're more likely to reduce your risk. So all of these elements are kind of pointing in the right direction. But I think investors at this point are still not yet, and all of us are still not yet clear on what are kind of our priority within all of these different metrics. And I think we'll learn. But the first thing I think to learn is to have the data. And so far, we're trying to look at this information without really being able to compare, as the previous speaker was saying, apples to apples. So once we have all the apples lined up with all the oranges and everything, then we can start to think about this a little bit more systematically with information that we can trust and information that we can compare. So change, behavior change starts honestly first with knowledge. You know that there's a problem, you're able to evaluate the problem. And once you do that, or maybe you can control the problem. So what can you do about it? And this next step is, are you going to do it? Motivation. So we're just starting the beginning. What does this information tell us? What is the amount of greenhouse gas emission that we have to deal with? What are all these kind of problems? What do they look like? That's kind of looking at the problem now. Next step is to look at, at solutions. What can we do about this? But without disclosure, we won't be able to even start, with the first step.
Certainly. So we've talked a bit about... I'm sorry, good, good.
Just, yeah. And what I wanted to say is just not disclosure, it's a mandated disclosure. I think it's really important that disclosure is mandated, so everyone has to provide the information. Because right now it's voluntary disclosure, so only some companies, those who maybe have more resources, but maybe also those that are doing better, that are disclosing. So we are not really able to evaluate the entire issue, the problem at stake.
If I could just jump in just to add on to that. So, for instance, when after the George Floyd murder, we were looking around saying, how do you evaluate companies on racial justice? And we didn't find any measures. So we actually created 57 key performance indicators of racial justice and diversity, equity, inclusion. And our research team went out and evaluated the Russell 1000, so 1,000 companies. And we were able to now to see who's a leader, who's a laggard. And we could sit down with a company and say, look, you scored a 5, your direct competitor scored a 35. And here's why. These are the 5 things they're doing you're not. And almost 100% of the companies thanked us for this. They said that the way that we were measuring them was really something that they could work with. And we filed these resolutions at 27 companies. Every company agreed that they needed to improve, and we withdrew all those resolutions. So none of them even went to a vote. But you can see that the companies understand that they want to create a culture that's going to attract the best and the brightest. And so the tools that we build help them to do that.
That's really interesting. Wow. Now we have another audience question for you. This is from Christina De Concini, Director of Government Affairs at the World Resources Institute. Christina asks, what do you make of the fact that Republicans on the Hill are targeting ESG and generating a lot of negative media about it with a great deal of misinformation?
I can go first if you like. I think that they are using those 3 letters for political gain without actually evaluating what it means. That what they're saying is we want more risk. We want the companies to have more risk. We want investors to have more risk. That if you're anti-ESG, then you're really saying you don't want companies to evaluate and take care of risk and to be more competitive. So they're saying that they want to invest in companies that are less competitive and are not addressing risk. It doesn't really make any investing sense at all.
Well, I think, as you know, we are in a bipolarized world where the environment and the kind of potential environmental regulation is going to be fought by the Republicans. So that's kind of where we are. But we're just asking in this case, with the new SEC, disclosure, they're just asking for disclosure. It's just not even, reduction. Imagine. So we're kind of far from, the 70s where we had the Clean Air Act and, a bunch of regulations coming in. We're just asking the information. And how would that be a problem to be transparent? So, I'm a big fan of information policies. We have examples, the Right to Know Act 1986 after the Bhopal, kind of catastrophe in India, where we said, as a community, as a citizen, you have the right to know what's happening in your backyard. And that's how the toxic release inventory started, where facilities have to disclose information about the toxic releases that they emit to the environment. And that is being, shown to be quite successful as a policy. There have been other examples in the electric utilities also that have kind of made big differences. So I think that we just need to kind of see about this where we are in terms of level. We're not asking reductions at this point. It's just to look at the kind of scope of the problem.
Definitely, I do want to acknowledge another SEC rule and this is about ESG fund naming. So as you saw, we evaluate 3,000 mutual funds every month on environmental, social, and governance issues, including private prisons, fossil fuels, deforestation. And we looked and we saw there's 94 funds that have ESG in their name. And we looked at them and noticed that 60 of them got a D or an F from us on ESG. And when we looked deeper and we had a team of data scientists do this analysis, and we brought all this data to the SEC actually. And what we noticed is that there's a lot of great ESG funds that have been there for 30 years, Trillium and Green Century and Parnassus and Pax, actually doing ESG. But the ones that were named, had ESG in their name, were Vanguard, BlackRock funds that had just changed their name but not changed their holdings, because they wanted to be they wanted to get more investment. So BlackRock has a low carbon transition fund, for example, that got $1.25 billion the first day. It was a record. It's got Exxon, Chevron, Duke, Southern, pipeline companies, deforestation, weapons, private prisons. It's basically your extractive economy fund, but they call it low carbon, and people invest to reduce their risk from climate. And so the SEC just came out with a new fund naming rule just on May 25th that also addresses this problem. It's not an ESG problem, it's a labeling problem, and they're addressing the labeling. And so we're happy to see that as well.
Certainly, a lot to think about here.
Yeah.
And thank you so much for your perspectives. Many thanks to Andrew Behar, president of As You Sow, and Magali Delmas, professor of management at the UCLA Institute of the Environment.